Welcome, and thank you for your time. This is the Queen Mary Simmons Fund, and today we will present our analysis on our investment strategy. The objectives of our analysis were to identify the optimal capital allocation across specific equity markets, while also tailoring it to individual investor preferences. Furthermore, we also assessed the profitability of carry trade strategies and came up with the optimal investment strategy to pursue in the near future. For this analysis, we used data from December 1996 to December 2019 for 15 MSCI total return indices, alongside the respective interest rates, spot rates, and forward rates. Furthermore, the full list of assets can be seen in the second section of this slide. And although the LIBOR may have been a better estimate of the actual borrowing and lending costs, we use the T-bill rate as a risk-free proxy for the asset pricing model because the LIBOR also incorporated credit and liquidity risks. And finally, for the Fama-French factors we used in our regressions, we took them from the Kenneth French website.
Moving on to our asset pricing model, we decided to use the CAPM model over historical returns over the former French model due to its higher statistical accuracy. We decided not to rely on historical returns due to their tendency to produce biased estimations and the lack of distinction between compensated and uncompensated risk. Although the former French meaningfully captures exposure from the market, as shown by the second column in the table, and does not leave abnormal returns unexplained as shown by the first column, it produces unsatisfactory results with respect to other risk factors of small minus big and high minus low. As they're not significant for majority of the assets, this can reduce the reliability of expected return estimates by introducing noise. On the other hand, CAPM produced satisfactory results. Looking at the first table, it does not leave abnormal returns unexplained, as shown by the first column, and show that the market meaningfully explains variations in returns, as shown by the second column. The second table compares the adjusted R square with Fama French and shows that CAPM produces better estimations for all assets but the US index. A possible explanation is that while Fama French uses the US market as a benchmark, we used a broader index, that is the MSCI World, in our CAPM model. These are our efficient frontiers for the equity indices. The efficient frontier shows the maximum expected return achievable for a given level of risk by combining the assets considered. Our point of interest in this figure is the tangency portfolio, which provides the highest expected return per unit of risk on our frontier. The capital market line shows the expected return and risk of portfolios combining the market portfolio and the risk-free rate. As this line is not tangent to the frontier but lies above it, the market portfolio, that is the MSCI World Index, appears to be our optimal risky portfolio as it provides a higher expected return per unit of risk.
Moving on to the tangency portfolio, the pie chart on the left shows the allocation of capital across the 14 equity markets that achieve the best risk-return trade-off, measured by the Sharpe ratio. And although this portfolio achieves higher expected excess returns in absolute terms, it has also a higher standard deviation than the index. This can be seen by comparing the Sharpe ratios in the table, which indicate that the optimal risky asset is not the tangency portfolio, but the MSCI World Index. This can be further explained by the higher diversification of the index, which is caused by various other assets being added than the ones considered for the tangency portfolio. And introducing transaction costs in the analysis would also reinforce the argument that the MSCI world is optimal, as it would lead to lower transaction costs than constructing a portfolio of 14 assets. For the investor's optimal portfolio, we combined the optimal risky portfolio, which consists of the MSCI World Index and the risk-free asset. The weights allocated to each depended on the risk preferences of individual investors, which we measured through the risk aversion coefficient lambda. And the table shows us the results for one of these investors for whom we assumed a lambda value of 5, and we chose this because it led to a balanced optimal portfolio with around 50% allocated to each asset. The performance of this particular portfolio can be seen in the graph on the right, which shows the growth of a dollar invested in December 1996, and this dollar reached $2.80 in December 2019. As mentioned previously, the lambda coefficient affects the model, with the left graph showing us how the changes in risk preferences affect the weight allocated to the optimal risky portfolio. These weights are decreasing exponentially as investors become more risk averse. And once again, the graph on the right shows the growth of a dollar invested in December 1996. Except this time around, we can see multiple risk aversion coefficients for our investors and not just one for the investor with a lambda coefficient of 5. And as we can see, more risk averse investors aim at lower but less volatile expected returns, while less risk averse investors will aim for much higher expected returns but with greater uncertainty.
Moving on to the second objective of our analysis, we tried to identify the profitability of a carry trade strategy. For this strategy, we took a long position in the three currencies with the highest interest rates and a short position in three with the lowest interest rates from the previous month. The excess returns of the portfolio were determined using the currency's excess returns. We then identified the optimal weights to allocate to each currency that maximizes the Sharpe ratio over the sample period. The resulting portfolio returns were regressed from the Fama French factors to identify whether the returns are the result of factor exposure. Overall, the long-short portfolio statistics in the table show significantly positive returns and higher Sharpe ratio than individual long and short portfolios and also of the MSCI World Index. The regression with the Fama French factors explained part of the performances through standard risk factors. The strategy has some exposure to the market with a beta of 0.29 and the high minus low factor with a beta of 0.27. The small minus big factor is statistically insignificant. Overall, a significant part of the returns is not explained by factor exposure, but rather by abnormal returns. This means the strategy has a monthly alpha of 0.36% and an annual alpha of 4.3%. Here we have a graph that shows the value of the carry trade strategy when allocating $1 to the long portfolio and $1 to the short portfolio. Overall, the strategy returned $1.40. The strategy showed strong performance until 2008 with some positive performance later until 2011. From 2011 onwards, the strategy did not yield any significant returns, with the value of the portfolio dropping slightly. This analysis is further supported by the research of Shenzhen Fan et al. In 2021, which showed weak performances for the strategy after 2011. The graphs on the right, taken from their paper, compare the cumulative excess returns of the carry trade strategy and the S&P 500. Both moved closely together until 2009. However, from 2011, their trends diverged, with the carry trade visibly underperforming the S&P 500.
To carry out our analysis, we introduced a number of assumptions, and it is important to consider how relaxing them would affect our findings. Firstly, it is important to note that the carry trade strategy, which involves changing the composition of the portfolio on a monthly basis, would incur a significant amount of transaction costs. These have not been taken into account throughout the analysis and would reduce the expected return and the value of the portfolio over the sample period. In addition, we also assumed no legal and regulatory barriers, such as borrowing limits or taxes, which could reduce, once again, the profitability or even the ability for the investor to properly implement the carry trade strategy. And finally, it is also equally important to note that the bid-ask spread, although generally small, can lead to an additional reduction in returns when compounded over the investment period. And moving on to the limitations of the optimal portfolio, including the MSCI World Index and the risk-free asset, we must note that lending and borrowing rates usually differ, which we assume to be the same in our calculations. This would then create a kink in the capital market line and would also affect the optimal portfolio weights, which would then require further adjustment. And finally, although the CAPM was the optimal among the asset pricing models considered, it explained an average of around 70% of the variations in index returns. If a different asset pricing model was used, which ended up being more accurate or less accurate, this would once again affect the results and also the optimal allocations for our portfolio. And so, in conclusion, although our analysis provided the general overview of the performances of our strategies, the limitations just described should be taken into consideration before any prior implementation. In addition, the results would need to be re-evaluated periodically to ensure new information is taken into account. Also, accurate measurement and periodical adjustment of individual investors' risk aversion parameters are essential, as inaccurate preferences would lead to misleading optimal allocations in the optimal portfolio. And finally, while the carry trade strategy yielded a higher Sharpe ratio in the sample period compared to equities, its recent poor performances should also be taken into consideration before choosing this strategy. These are our references. Thank you for your time.